Hey everyone, and welcome to the Business Basics Hub. So you've heard about the S Corporation, right? People are always talking about how it can save you a ton of money on taxes. But how does it really work? Well, let's find out.
Okay, before we dive in, just a quick disclaimer. Everything we're going to talk about today is for educational purposes only. This is not legal or tax advice, so please always chat with the professional about your own unique situation.
All right, let's talk about the S Corp. You hear this term thrown around all the time, and it's often painted as this magic key to slashing your tax bill. But what's the real story? And maybe the most important question of all, is it the right move for your business? We're going to break it all down in plain English.
So to really get why S Corps are even a thing, you have to understand the problem they were designed to solve. And it's a big one, a real headache for business owners called double taxation. Trust me, it can take a serious bite out of your hard-earned profits.
I mean, just think about this for a second. Your business works hard, you make a profit, and then that same money gets taxed. And not just once, but potentially twice before you ever see a dime of it in your personal bank account. Yeah, nobody wants that.
Here's how that double hit works with a standard C corporation. First, the business itself pays corporate taxes on its profits. Bam, tax number one. Then, when you take that money out for yourself as a dividend, you pay personal income tax on it. Bam, tax number two. It's a real double whammy. But an S corporation, it totally avoids that. The profits just pass through directly to you, so they only get taxed once. That is a huge difference.
Okay, so we know why it exists, to avoid that nasty double tax. But now, let's get into what an S Corp actually is, because we need to clear up the single biggest misunderstanding out there. Seriously, this one point trips up so many new business owners.
Okay, here it is, the big secret. An S corporation is not a type of company. You can't just go to your state's website and say, I'd like to form an S corp, please. It doesn't work that way. It is a tax election. It's a special status you ask the IRS for a business that already exists, like your limited liability company or your C corporation.
The easiest way to think about it is like this. You're putting a special tax hat on your business. Your LLC or corporation is still there. That's your company structure. The S Corp election is just you telling the IRS, hey, you see this company? From now on, I want you to tax it in this special way, using the S Corp rules.
And what's the superpower that comes with this tax hat? It's that pass-through taxation we just talked about. All the profits, and hey, even the losses, flow directly onto your personal tax return. That corporate-level income tax, it's gone. You're back to only being taxed once.
Now, this special tax status sounds pretty awesome, right? But it's not a free-for-all. The Internal Revenue Service is very particular about who gets to play this game. They have a really strict checklist, so let's walk through the rules you have to follow to even qualify.
All right, here's the checklist straight from the IRS. First up, your business has to be a domestic one, right here in the US. The shareholders, they have to be actual people, individuals. You can't have other companies as shareholders. And they need to be US citizens or residents. Next, you can't have more than 100 shareholders. And finally, only one class of stock is allowed. You have to check off every single one of these boxes, no exceptions.
The good news is, if you do qualify, making it happen is actually pretty straightforward. It's basically a four-step path. First, you double-check that you're eligible. Step 2, you fill out a special IRS form. It's called Form 2553. Step 3, and this is super important, every single shareholder has to sign that form. And then step 4, you just file it with the IRS on time.
All right, everybody, lean in for this next part. I am not kidding. This is the single most important part of this entire explainer. If you forget everything else I've said today and only remember one thing about running an S Corp, this is it. This is the golden rule, and you absolutely cannot ignore it.
What is it? Well, it's the number one thing that gets S Corps audited. I'm being completely serious here. Failing to follow this one rule is like sending a formal gold-embossed invitation to the Internal Revenue Service that says, hey, please come audit me. I'd love for you to take a super close look at all my finances.
So what is this big, scary rule? It's simple. You must pay yourself a reasonable salary. So what does that mean in plain English? It means you have to pay yourself a fair wage for the work you actually do for the company. The best way to figure it out is to ask yourself, if I quit tomorrow, what would I have to pay someone else to come in and do my job? That number, that's your reasonable salary.
And hey, don't just take my word for it. This is literally a quote from the IRS's own instructions. They spell it out crystal clear. If you're an officer in the company, which you probably are, and you're doing work, then you have to be paid wages for that work. You can't just call all your pay a distribution to get around paying payroll taxes. The IRS is not a fan of that.
And this brings me to a really, really dangerous myth that's floating around out there. Maybe you've heard of it, the 60-40 rule. People will say, oh, just pay yourself 60% of the profits as salary and take the other 40% as a distribution. Let me be 100% clear. That is a myth. There is no magic ratio. It is not a real IRS rule. And just blindly following some made-up formula is a massive risk.
Woo! Okay, that was a lot of info. So let's just take a breath and do a quick recap of the absolute essentials you need to remember about S corporations.
Okay, remember these 3 things. Number 1, an S-Corp is a tax choice, not a type of company. Number 2, the rules to qualify are super strict. Not just anyone can do it. And number 3, the golden rule. You absolutely must pay yourself a fair, reasonable salary for the work you do. That part is totally non-negotiable.
So, is an S-Corp right for you? Maybe. But the only way to know for sure is to talk it over with your certified public accountant or tax advisor. And to help you get that conversation started, we've put together a totally free checklist that you can download. It'll help you ask all the right questions.
Hey, if this explainer helps clear things up for you, do us a huge favor and hit that like button. Subscribe to Business Basics Hub and ring that little notification bell. That way you won't miss our next guide, where we break down another tricky business topic.
And one last thing, we really want to hear from you. What's another business topic that just confuses the heck out of you? Let us know in the comments below. We might just tackle it in our next explainer.
Thanks so much for watching, everyone. And just one last time, remember this is all for your education. Make sure you talk to a qualified professional for advice tailored to your specific business. See you next time.